All right, good morning and welcome to the show. Just half an hour to the opening bell here in Hong Kong, in Shanghai, and also in Shenzhen. You're watching the China Show. I'm David Ingles with Rebecca Choong-Wilkins.
Our top stories this morning. U.S. futures rise, but Asian stocks are struggling, and that comes amid signs President Trump's next round of tariffs could be more measured than previously expected. Now, it's China's busiest week of earnings so far this season. We are kicking off with BYD, expected to report record sales of more than $100 billion, while rival Tesla grapples with a slump in its major market.
And I'm Stephen Engel inside the Diaoyutai State Guest House in western Beijing at the China Development Forum, where Premier Li Qiang says China is preparing for Trump tariff shocks that exceed expectations. This as visiting U.S. Senator Steve Daines tells us exclusively that Beijing must fix its fentanyl flow before any further trade negotiations with the U.S. can happen.
Again, a very good morning to all of you joining us from across the region. Good evening if you're joining us out of the United States, of course. If you're in Europe, why are you still up? Time to go to bed. There's a lot to discuss and dissect as we go into the first session of the week. Certainly there's a lot happening right now, and quite an eventful weekend here as far as the geopolitical conversation is concerned. We had, of course, a pickup in U.S. futures, and you are seeing that, and a substantial one at that. So that's actually a move you don't normally see on U.S. contracts for this time of the day in the Asia-Pacific. Might it be down, and we'll unpack the story a little bit further for you later on in the show, might this be down to the fact that Donald Trump, as he is preparing and his team are prepared to announce retaliatory tariffs, be more targeted than initially thought? So there is a paring back of risk appetite, a paring back of risk premiums, rather, at that. The other thing going on as well, and we'll get more on this in a moment here, is, of course, all the political developments taking place in South Korea, where, of course, you are looking at things like a constitutional court beginning, of course, his impeachment ruling. We'll get to that in a moment. Now, that's the Asia-Pacific story. That's the U.S. story. On the weekend, though, and of course, in the slightest that you've missed this, Turkey will keep on top of all the story and developments coming out of that market. The equity market, in case you missed it, had its worst week. Biggest single week drop going back to the global financial crisis, down 17% in the main gauge. In fact, just the capital markets regulator late on Sunday announced a ban on short selling, among other measures stemmed, or at least aimed at stemming this rout. Markets in Israel, equity markets in Israel, tanked over 3% on Sunday. More on that in a moment, of course. So it's, again, a very eventful week going into today. Not to mention as well a couple of other things. Canada, I think, also mentioned that elections are coming through end of April. That's the global story. Let's have a look at where we are as far as China goes and the approach to the open. Keep in mind, we're coming off the worst two-day slump on Hong Kong benchmarks since about October, right? So is this one of those pullbacks where you're going to get mainland buying coming through? Yet to be seen. We are seeing a pickup right now across some of the contracts right now. And yeah, dollar China on your screens right now. We are near a bad day away from entering a technical correction on the Hang Seng Tech Index, but early indications are we will be pushing that concern aside, at least for now. And, of course, earnings, we'll talk about that later. A ton of earnings coming through today and throughout the course of this week. Rebecca.
Yeah, just quickly switching to some of that breaking news that you touched on a moment ago. So South Korean Court has dismissed the impeachment of Prime Minister Han Duck-soo. Of course, we were watching that very, very closely. The big implication is that, of course, he will now be immediately restored to acting presidency. He had been suspended from office since late last year after resigning from pressure from the opposition party. Really big news. We've been watching this very, very closely this morning.
Yeah, there we go. With $1 on your screens, 14.65, just a move up just above the zero level at that. Right. It's also a big weekend as far as China goes, of course, the China Development Conference, of course, and we did hear, of course, from Premier Li.
That's right. I mean, we really are now sort of counting down to the reciprocal tariffs coming in, expected on April 2nd. We did hear from Chinese Premier Li Qiang, as you say. He's saying the country is preparing for shocks, as President Trump is also himself preparing to announce more of these tariffs on U.S. trading partners next month.
We may have unexpected shocks mainly from external factors. When necessary, the Chinese government will introduce new incremental policies to ensure the smooth operation of the Chinese economy.
And let's bring in Stephen Engel, our chief North Asia correspondent. He's at the CDF, the China Development Forum in Beijing for us. Steve, it was a busy Sunday for you guys. Just help us understand what the conversations were and, really what the mood is on the ground ahead of these tariffs kicking in on April the 2nd.
There's nothing better than local knowledge, and that's why all these multinational executives are here, whether it's Tim Cook of Apple, of course, Blackstone, Steve Schwarzman, Albert Bourla of Pfizer, the Saudi Aramco president just walked past me. So they're all here to kind of get a feel for what China's reaction is going to be to what has been a fairly well-telegraphed trade action by the Trump administration. There are going to be tariffs. There's already an additional 20% because of the fentanyl issue. We'll get to that in just a second. When I talk about my exclusive interview with Lucille Liu, is when we interviewed Steve Daines late yesterday before he flew back to Washington, D.C. But essentially, we're all trying to figure out what China's response to the Trump tariffs are going to be. And that's, of course, boosting domestic consumption and also essentially bringing efficiencies into the supply chain in China. There was a lot of buzz about AI here in this hall in Villa 14 of the Diaoyutai State Guest House, including the chairman of Siemens, who also talked right after Li Chong, talking about industrial AI. Others who I've talked to say this might, lead to, the Trump tariffs might lead to unintended consequences, and that is essentially China forcing to increase efficiency and increasing domestic consumption at the expense, perhaps, of cheaper exports to places like the United States. So much was talked about, including on the geopolitical front and the risk mitigation from those Trump tariffs.
Steve, you also had a conversation with U.S. Senator Steve Daines, a sort of character who's somewhat cast himself as this possible go-between between Washington and Beijing.
That's right. So Steve Daines, the Republican senator from Montana, was here as sort of an unofficial envoy of Donald Trump to the China Development Forum. He had a meeting in the Great Hall of the People late yesterday along with the CEOs of 7 American companies, and he delivered a message about fentanyl. And this is our conversation. Both Bloomberg News colleague Lucille Liu and I spent about 10 minutes on the phone with Steve Daines after his meeting with Li Chong at the Great Hall of the People, and just as he was boarding his flight back to the United States. Here's what he had to say.
It was a constructive conversation. I think the President Trump position was heard loud and clear, and the Chinese received that. They understood it, and we're hopeful that we'll see decisive actions taken to stop the flow of these precursors.
Mm-hmm. Were there signals that they would proceed with some further actions on fentanyl?
Yeah, I think we had a constructive wrap-up in the meeting. And again, I'll allow my Chinese counterparts to provide their readout on the meeting. But it was, I think we ended on a constructive note.
Okay. And how would you say is the biggest barrier right now to Trump and Xi meeting? Is it fentanyl, or are there other barriers at the moment?
No, I don't think so. I think it's just a matter of finding a time that's going to work for both President Xi and President Trump.
And do you think that will be in the U.S. or China or a third country?
It's a good question. I don't know. Again, they're two busy leaders dealing with a lot of issues. The China-U.S. relationship is one of the very important issues, and I'm confident they're going to find the right time and the right place to meet.
One of the things, Senator, that I've been hearing a lot through state media and from Chinese officials is they don't necessarily know exactly what the Trump administration wants to address these 20% tariffs. What would it take from the Trump administration to potentially reduce those 20% tariffs and mitigate any other tariffs that might come down after April 2nd? And is this something that the Chinese leadership addressed with you?
Well, again, the president made it very clear. He made it clear to me. He's made it clear to the American people. He's made it clear to the Chinese government that stopping the flow of these fentanyl precursors is his highest priority. And it'll be difficult to have any conversation about tariffs and non-tariff barriers until the fentanyl precursor issue is resolved.
So there you have it. He basically said that there will not be room for further trade mitigation negotiations with China until the fentanyl issue is resolved, or at least adequately addressed to the liking of the Trump administration. And that puts the Chinese obviously in a bit of a pickle, because their narrative so far has been, this is not a Chinese problem. This is a U.S. demand issue. China has some of the toughest anti-narcotics trade laws in the world, and they're not necessarily going to say we haven't done enough. In state media readouts of this meeting with Steve Daines, there was no mention at all, actually, of fentanyl.
That's Bloomberg's chief North Asia correspondent, Stephen Engel, in Beijing with the very, very latest for us. And elsewhere, really a full docket for today in Hong Kong, particularly on the markets front. We're looking at that potential correction in the HS Tech. We are about a couple of % off there. And part of that story has, of course, been this weakness that we've seen in southbound flows. We've had negative declines there for about 4 weeks now. We saw a bit of a rebound coming through the end of last week, but really has failed to offset some of the weakness we saw at the very, very opening of the week. Part of that story, of course, is this question mark over and investors wanting to see these stronger signs of economic growth when it comes to China. We'll keep keeping a close eye on earnings as part of that. We do have some of China's biggest banks, its consumer firms, all coming through today. That could offer a fresh catalyst. It could potentially offer fresh sign and a fresh sort of clue for how the economy is coping. Of course, we have Steve at the China Development Forum. Dave.
Yeah, it's a immensely jam-packed agenda when you look at today. We haven't even talked about this big event as well on the Hong Kong exchanges, of course, there. And, of course, today is somewhat of a special day as far as this ETF story goes, because we do have the launch of single stock, leveraged, and inverse ETFs here in Hong Kong. So we'll have the conversation later on, of course, with the fund manager in charge of that. Going into the open today, of course, in Shanghai and Shenzhen and here in Hong Kong, a very big week, major conferences in the city. And you know what? The weather, Hong Kong is showing off. Immaculate weather going into these next few days or so. 17 minutes of the opening bell. You're watching the China Show, and good morning. Right, welcome back. We're kicking off a major week of just immense events coming through here in Hong Kong, of course. To cap off the week, of course, it's Art Basel and the 7th this coming weekend. But to kick things off, we have the Milken Institute. They're holding their second Global Investor Symposium here in the city. And, of course, Avril Hong is with us here. She's at the conference for us right now. We brought her in from another financial capital here in the region, Singapore, to take us through. Avril, yeah, what are the conversations you've had so far? And you have a good one coming up.
Yeah, from one financial capital to another, right? And the talk of the town is really about tariffs, what we could see potentially come April 2nd. So that's the geopolitical backdrop that China's kind of dealing with. How is this going to affect real estate on the mainland and in Hong Kong at a time when it is still struggling? I have with me now Goodwin, Chairman, Managing Principal, and Co-founder of Gore Capital Partners. Great to have you with us, Goodwin. So when you look at what potentially we might see come April 2nd, do you think China is ready for the potential shocks? I mean, we might see a narrower scope, but it's more about the uncertainty, the back and forth.
Well, there's a Chinese saying, right? As we say, if money can solve a problem, it's not really a problem. But obviously, it's hard to be in business these days without understanding or figuring out how geopolitics play a role. And it is difficult to predict because everything is really unpredictable. And when everything is unpredictable, you do have to be cautious. I mean, the real estate market in particular, about 3 or 4 years globally has been on the turmoil just because of the significant hike in interest rate.
What about on the mainland? How is all this potentially going to affect the bottoming out that we see both in commercial and residential real estate?
I think mainland is a harder read just because the capital markets to support real estate is not as robust and certainly not as international as before. And with that as a backdrop, residential obviously is in the headline news. Commercial less so, because commercial, the occupancy in office towers by and large in tier 1 cities in China are pretty healthy. So you do have a cash flow against a backdrop of lowering interest rate because of the slower economy. So commercial is less of an issue, but capital markets may not be there to create exits. Residential, it's a whole different matter, right? Because many of these developers, very large portfolio across both tier 1, tier 2, and tier 3 cities are all in trouble because they were over-indebted. But it's a whole cycle of the Chinese real estate game. Municipalities get the income to fund the civic projects from selling land. So developers, a large one, have to go all across the country. So you do have a supply-demand imbalance, more so in tier 2 to tier 3 cities, whereas tier 1 cities like Shanghai and Beijing and Shenzhen are by and large quite balanced. So if you have a balanced supply and demand, or even demand exceeding supply, the over-indebted projects eventually will sort itself out pretty quickly.
What are you seeing in terms of the refinancing of existing projects in China and Hong Kong? How is it being affected by the bank funding tightening?
In China, actually, the funding is not tightening. If anything, in China, the funding is loosening. So if you have income-producing commercial assets, it's relatively easy to get refinancing. And in hot sectors like data centers, we have seen projects getting financed 80 to 85% because there's income coming in. But on the residential sector, as I mentioned, in tier 1 cities where the supply-demand is more in balance, it's actually much easier. But in many of these tier 2, tier 3 cities where the demand, you can't foresee where the demand is coming from, they're unlikely to get refinanced, so the state will likely have to step in. Hong Kong is quite different. Hong Kong, there's actually a significant amount of liquidity in the banking system. But unlike U.S., the Hong Kong banks doesn't have a system like U.S. where these non-recourse debt are marked to market and disposed of in an open market process quickly. So banks tend to hold on to recourse debt a lot longer on the balance sheet. Hence, the reset is not quite there. As a result, the adjustment will take longer.
Yeah, so I mean, this is the second year at least that markets have had to adjust their Fed rate cut expectations, right? So overall, how much further does this push back the real estate resetting?
The real estate resetting is less about adjusting the rates. If anything, there's an arbitrage today. As you know, Hong Kong dollar and US dollar is completely pegged. Yet the Hong Kong dollar borrowing rate is, you can actually borrow Hong Kong dollars and park the cash in US dollars and make over 1% spread, despite the ironclad peg. Or if anything, it's a hedge, because if Hong Kong dollars actually readjust the peg, which is unlikely to happen, it should weaken, and you likely will actually make even more money. So that tells you how much liquidity is in Hong Kong's banking system. It's just the banks are obviously skittish to lend because they have problem assets on their hand. So it does take a market to reset, or it takes the economy. It actually, if anything, Hong Kong is a financial service-centric economy, one of the 3 financial gateway of the world. If the IPO market resets, almost a lot of issues will take care of itself.
Yeah. Some things have to kind of fall in place, but we're kind of getting there. Goodwin, really good to chat with you. Thanks so much for sharing your time and your insights with us. Goodwin Gore of Gore Capital Partners. Rebecca?
Thank you so much. That's Avril Hong at the Milken Institute Global Investors Symposium in Hong Kong for us. There's plenty more ahead. Stay with us. You're watching The China Show. Good morning. You're watching The China Show. We're just taking a quick peek at some of these big consumer names in Hong Kong. Tencent up about 0.5%. BY2 charging ahead 2%. And Meituan down nearly 3% in the very pre-session as we go into the trading day. Think about BYD. Of course, BYD on course now to report full-year revenue at about $100 billion for the first time. It's a milestone that will actually see it leapfrog electric vehicle rival Tesla. Let's bring in our China correspondent, Min Lo. First of all, earnings. What should we be watching for? What are the sort of big important numbers here?
Yeah, so BYD is a very important one to watch because potentially it could provide fresh catalyst to push this stock up to the one with the biggest market cap onshore for a non-state-owned companies, because it briefly surpassed CATL last week, and it could possibly again today because options traders are pricing in about a 4.5% move after the earnings call today. And you can see that revenue there expected to have grown by about 27% on year, and that's on the back of strong demand domestically. About 4.2 million cars sold, is the market leader in China. Overseas as well, its export had surged more than 70%, close to 420,000 cars sold. And as you said, its revenue expected to be a major milestone here for it to leapfrog Tesla. Investors will be looking out for the target, the sales target this year, and what its aggressive pricing strategy could mean for its margins. But this is a company that has been launching several new tech upgrades throughout the year. The latest is that EV charging model that could recharge within 5 minutes and giving you an extra range of 400 kilometers.
Okay, so big earnings week. What else is on tap this week?
Yeah, so we have about, I think, 200 companies that are reporting out of the MSCI Asia Pacific Index this week, and we're looking out for many of the consumer names like Midea, Popmart, Nongfu, and obviously because the government has unveiled this action plan to boost consumption, but that press conference had failed to give us anything new, investors will be looking ahead to these earnings for a potential catalyst here. Popmart is a crowd favorite because those blind boxes have been flying off the shelves domestically and overseas as well, really riding on that emotional spending pattern. Midea could benefit from that equipment upgrading program, but Harilela, its earnings probably expected to be softer because of the weakness in the catering sector. And of course, we're also looking out for the banking sector reporting earnings this week as well. China Construction Bank, ICBC. We're looking out for whether these banks could be seeing their margins being quite challenged once again as they are being asked to take on more responsibility to shore up the economy. We had mortgage rate cuts last year, interest rates remaining quite depressed both domestically and overseas as well.
All right, it's going to be extremely busy, as Min was pointing out there. Our China correspondent on what to watch. The company's reporting the report cards this week. Yeah, and we're going into the open today, of course. We're calling this sleepless on the sell side. There we go. So as you unpack, of course, those earnings, get those new reports out, and maybe some changes to where you think those stocks should be going into the next trading session. We're looking at 0.5% to the upside here on some of these benchmarks. I'm looking at my screens here. 23.8 right now in the Hang Seng Index. We're coming off the steepest two-day loss, of course, on price going back to October on this benchmark. But it's looking like a good start to the week with some modest gains going into the opening bell. Just over 3 minutes away, you're watching the China Show. Good morning.
Good morning and a happy Monday. Welcome back. You're watching The China Show. We are counting down to the open of markets. 30 seconds off and change. And it does look like we are perhaps seeing a little bit of positive momentum coming back into the market. We entered looking at some of these index, wondering if we were going to finally see a correction. We've also had somewhat lackluster flows coming in from southbound. Looks like maybe the temperature might be changing here, Dave.
Yeah, and it looks like, you know, on one hand, you do have Donald Trump coming out, and of course, the narrative or the notion that while we might get more tariffs, certainly, they won't be as sort of wide in breadth as initially expected. So I think you're really seeing that as far as U.S. futures go. In case you're wondering what you're looking at on your screens as well, the countdown clock, and of course CSOP will be launching, and this is a new thing as well because we'll be joined, in fact, by the CEO in a couple of minutes here later on the show. They're launching single stock ETFs in Hong Kong, leveraged, inverse, NVIDIA, Teslas. You can bet on those ones, of course, here in the city. There we go, on the right side of your screens. We'll check pricing in a moment here. In the meantime, though, very, very quickly, as you can see the benchmark, nothing much happening there on the benchmark itself. You have a couple of items to note here going into the agenda today as far as the mail-in markets are concerned here. So you have a bond auction, 5-year bonds, about 180 or so billion coming through today as far as supply. You also have margin financing. We talked about this, right? Is, you know, you're sort of under the hood indicator of risk appetite has been slowly picking up of late. So I'm going to put this together with, you know, we're seeing it pick up for 6 straight weeks. That's number one. Number two is at some point, this shrinking premium, if not already, the shrinking premium that you have on the H-share market over A-shares is effectively now the lowest, statistical lowest here going back several years. It's at a point where you tend to see that re-widen out. So let's watch it very, very closely. We're in the thick of earnings season as well, so we'll have a look at that and some of the earnings reaction there. Meituan, of course, and some of the, I guess you could say, disappointment in the markets. To change the page, please, if we can, in terms of the international expansion and some of the losses there and maybe the profit outlook. We were talking about 54.94. It might be a level to watch, not so much today, but in the coming days. But I mean, we'll see how we end the day. But we're up 0.5%. The reason that's important is that below that, a close below that would put us into a technical correction. Right. Do we have the? Yeah. Okay. Thank you so much. This is the Hong Kong board. Yes. Okay. Sorry, I'm confused. Ton of screens here in front of me.
It's Monday after all, Dave.
It is. And
it's forgivable.
You need coffee?
I mean, maybe after this.
Yeah, okay. Just take that as a cue. Let's have a look at, so some other things to wake you up here. So you have Zhaojin Mining coming out, and that's some downside today. This is on the back of a share sale it announced a couple of hours back. Number one is clearly 1HK. Richard Lee is invited to attend the CDF, of course, in Beijing. That's all we know so far. We're up 2% as far as that's concerned. Kingsoft getting a downgrade there, coming out of China Renaissance. And you have NIO, of course, also. That's a earnings story from Friday. Right. Let's have a look at U.S. futures. And, yeah, this is your bright spot, right? We were talking about this, that we're pulling back in terms of pessimism going into the week. And a lot of it, if not everything, is down perhaps to this. The new tariffs are seen as more targeted. It's only playing out, though, mainly in U.S. assets today. The rest of Asia is still fairly lethargic this Monday.
Yeah, the big point that you mentioned there really is about this recalibration. Are the tariffs that we see from Trump going to perhaps be a little bit moderate, a bit more measured than we initially priced in? That's been a big topic of discussion, according to Avril Hong. She's with us at the Milken Institute Symposium that's underway just around the corner, in fact, in the Four Seasons. Avril is there with our very next guest. Avril.
Yeah, I'm not far from where you guys are, but, there still seems to be a gulf of sorts when it comes to tariff implementation expectations, what we're going to see next week. And, of course, China really top of mind for global investors. And it's fair to say that I think U.S. policy has kind of driven this divergence in terms of monetary policy expectations, along with growth prospects for major regions. So joining me now, Janet Perumal is head of Asia Pacific at Wellington Management. Janet, really good to have you in the hot seat with us.
Thank you for having me.
What are you expecting for China for the year in terms of performance versus global markets?
Yeah, so I'm going to start with, obviously, China in the year-to-date period has been one of the best performing markets. And that's really been, if you think about DeepSeek, it's really reignited investor optimism and thinking about the growth prospects in China. I would say the thing that we're trying to sort of figure out is, will this be sustained, this rally in the market in China? And I think that there is absolutely room for this rally to sustain. And the reason I say that is thinking about valuation. So China, even though there's been interest in China and we're starting to see some flows back into the Chinese equity markets, the valuations are still significantly lower on a global basis, especially compared to the US market. So when you're coming off low multiples like that, that has the potential for it to sustain.
But that's a gap that's been narrowing, right?
It has been narrowing.
The correction
yeah, but there's still room to go.
Okay.
And then I think the second thing that our analysts are also pointing to, and as an example in the internet sector, there's some things that are kind of underappreciated by the global markets, and things such as, the quality of the companies are also changing. Some of the things that we're noting on our fundamental research from a bottom-up basis is really thinking about a focus on higher margins, more rational investments being made by these companies, and better return to shareholders. So, you really have to look under the hood to see what's going on there. But what I would say is that it feels like the macro might be bottoming, sentiment might be bottoming and sort of turning a little bit more positive. So it does have the ability for it to continue to sustain for 2025.
Okay, what about U.S. exceptionalism?
Yes, I know that's a question that's coming up a lot. I would just frame it more about, is it U.S. exceptionalism, or are we seeing a broadening of markets, both on a sector and by a market basis? as in the laggards have been catching up. So the US has definitely been the best performing market for a long period of time. But now we're starting to see broadening in sectors. So in the second half of 2024, in the US markets, we're starting to see other sectors doing better. Okay. And if you think about the comps, right, so the US mega caps have definitely been exceptional performance. But they're coming off very high profit levels as well as growth rates. So that actually bodes well for other sectors and companies.
So what is that going to mean for your extension strategies? What are you long and short on?
So the extension strategies are a really interesting way to think about it, because when you go and you try and allocate to, let's say, the S&P 500, it's very concentrated by the Magnificent Seven and so on the top end, right? So what the extension strategies allow us and allow our clients to benefit from is the ability to go 140-40. So take extra capital and neutralize the passive, but then really think about where we want to generate alpha in the tail of the S&P 500. So that's an area of interest for our clients globally around the extension strategies. One of the risks that investors really need to think about is when you make passive decisions, you're making an active decision given the concentration in markets. So while we're waiting for things to broaden out, and that's starting right now, you really should be thinking about the risks in the markets. And so, yeah.
Yeah, as we talk about that, it's so interesting. I mean, a year ago, we wouldn't be saying Europe.
Yes.
Growth narrative, gaining traction, yet here we are.
Yes.
What is the way to play that?
So I think Europe is a fantastic market for thinking through stock picking and active fundamentals, right? So taking a step back, how should investors be thinking? So one, we're in a world where interest rates and inflation are going to be structurally higher. The cost of capital will matter more. Secondly, there's going to be more intervention and dispersion, and we're seeing that in Europe as well, as we've seen some of the fiscal policy announcements coming out. So diversification will matter more. And thirdly, we're seeing a broadening, both by sector and market. And where there's a broadening, fundamentals will start to also catch up, meaning that performance will also start to matter more. So there, you've got to get your starting point right. So valuations are really going to matter. So we think in Europe, some of the areas that are going to be more interesting will be in the value sectors. So thinking through financials, telcos, and defense sectors. And then a really underappreciated market segment of the European market has been small cap.
Janet, just, because we're kind of tight on time here, but when it comes to the business strategy, what are you advocating in terms of the public-private market convergence? And, what are you telling pension funds, insurers, in terms of asset allocation?
So the private markets are definitely have been growing at an exponential rate. We're telling our clients, really think about how you want to allocate as you think about it as an ecosystem that's converging. So where are areas that you might not get access to in the public markets as an example? Biotech, AI and technology, where there's more private companies playing in that space. Or where can you get better yield enhancement alongside? So in credit portfolios for insurers, as an example, you've got your investment grade credit, but you can pick up some yield by doing private placements in investment grade.
What are the biggest gaps, you would say, in terms of private markets in the region and investors accessing those markets? Where do you see the biggest gaps?
I think the middle market is one area where it's probably not as robust as the US, but we're starting to see more interest maybe in late stage. So that's kind of an area that we are doing a lot more work in late stage private equity.
Janet, great to chat. Wide-ranging conversation. We covered a lot of ground.
Lovely to be here. Thank you, Avril.
Great stuff. Thank you so much. Janet Perumal of Wellington Management. David?
All right, lots more coming out there with Avril, who is roughing it at the Four Seasons. Avril Hong there, of course, at the Milken Institute Global Investor Symposium taking place here in the city. And by the way, as we were pointing out, there's lots more coming up there later on. Insights, and of course, as Linda, there we go, will be speaking with Eldridge Industries co-founder, chair, and CEO, Todd Bowley, for an exclusive chat, of course, about what they're planning here for the region. Catch that interview at those times on your screens.
Yeah, up next. So first, on the China Show, we are back live at the China Development Forum, asking global strategy firm Roland Berger for their take on China's economic recovery plans. Stay with us. There's much more ahead this morning. You're watching the China Show.
The tariff impact to us in 2018 was about $10 million. So it's a very small impact on a very large company. We'll continue to watch it carefully. We'll continue, but we're not going to react fast. We're going to watch what happens, and we're just going to make sure we continue to support our customers.
We're constantly looking at how to become even more resilient, and I think this regional approach is actually benefiting us. So to supply 75% of what we sell in Europe, and to supply 80% in Asia, for Asia is very good, and now we're building up also capabilities in Americas, and that we have been doing for the last decade.
Some views there from delegates at the China Development Forum, speaking with our chief North Asia correspondent, Stephen Engel, about the impact of tariffs on their businesses. Let's go back live to Steve in Beijing, who is at the CDF with our next guest. Steve.
Yeah, I think the common theme here in Villa 14 of the Diaoyutai State Guest House in Western Beijing has been how to navigate the uncertainty that the Trump trade policies have posed on the global economy. China obviously trying to adapt by boosting domestic consumption and building more AI-infused efficiency into the supply chain and their industrial base. How do MNCs, multinational corporations, deal with this uncertainty? That's been on the lips of most of the participants. Let's get to our next guest who can talk about that subject. It's Denis Depoux. He's the global managing director of Roland Berger, basically a Munich-based global strategist, a consultancy. So in your discussions here, and with your clients as well at large, what is the biggest advice you give them on how you can navigate this uncertainty?
Well, first of all, I think keep localizing in China to be a bit less dependent on global supply chain of China, but also to tap the incredible innovation trend in China. Because in spite of all the trade war, in spite of all the technology restrictions, there's a lot being invented here. And I think being in China is not only for global supply chain, it's not only to serve the Chinese market anymore, it's also now to tap some of the innovation, and that innovation can then be distributed elsewhere.
What has DeepSeek done to shed light, obviously, on China's AI ambitions? We heard the Siemens chairman yesterday speak after Li Chong, essentially saying we need to focus less on the consumer side of AI innovation and industrial AI.
Yeah, I think that has not come yet. So everybody focusing on DeepSeek and the sort of more consumption, AI consumption-driven growth. But the big revolution is when you can use AI in industrial machinery to improve quality, to improve the yield, to improve time to market, on-demand response to the market. And that's what Siemens was talking about yesterday. And of course, China remains the factory of the world, so that's very meaningful here. And also, China is now offshoring a lot of its production. Western companies are not necessarily the first one to de-risk China. Actually, Chinese companies are de-risking China by offshoring production elsewhere in the world, also because that's welcomed by the rest of the world to invest in Europe, maybe in the US, as President Trump even advocated in one of the pressers.
Well, last year in 2024, because of the slowdown of the Chinese economy, we saw foreign direct investment drop by the most since 1990, so 3 decades essentially. Do you see any signs that that can pick up, and how much is this tariff threat and uncertainty going to keep a lid on that?
Well, I think the drop last year is related to 2 things. First of all, it's a bit of a legacy of the COVID years. I mean, nothing has been discussed, so nothing gets decided, first of all. And second, of course, the rebound of the Chinese economy was not there. So it's rather a steady decline and fluctuation, rather a more normal economy as we see it elsewhere in the world. And as a result, you don't invest so much more if you're not certain about the demand that you need to address. You don't invest also in China as part of your global supply chain when you see that your Chinese suppliers are actually offshoring elsewhere.
How difficult is it for companies that you represent to navigate the gyrations of policy coming from the United States? I talked to Steve Daines, the senator from the United States, from Montana, who is a sort of the unofficial envoy of Donald Trump here, essentially telling me yesterday that China has to solve the fentanyl issue before they can go and do any other negotiations on trade issues, actual trade issues. The fentanyl issue is a tough one for China to address. So does that, come up in the boardrooms? How are we going to see more clarity on this issue if it's a subject of fentanyl that China doesn't acknowledge necessarily exists?
Well, I think gyration, the word you use, is a very nice word to describe the volatility, the versatility that all board members of any company invested in China is suffering from. I don't know about the fentanyl issue. What I know for sure is that this kind of uncertainty is taking a big toll on companies because they simply freeze investments. Even for Chinese companies here, which are clients or suppliers of multinationals here, that uncertainty is creating a lot of havoc. And it's even more than tariffs. I mean, Chinese companies, multinationals invested in China, are prepared for tariffs because they've been there since 2018, and of course now they come to a higher level, but there's a lot of productivity here. So that there are buffers that can at least shoulder some of it. And however, the uncertainty cannot be easily managed.
Well, clearly Li Qiang had a message of open markets and reform and multilateralism. The other side of this tariff story is what does it do to the U.S. economy? And you must be advising also clients that are saying, do we go and hitch their wagon to the Trump policies to invest in the United States, or is there a real threat of recession in the United States as the tariffs raise inflation potentially and also potentially reduce GDP growth?
I think that's the biggest risk for both Chinese companies and multinationals invested in China. If there is less U.S. demand, because U.S. is always the first or second trading partner of China, basically it has a huge impact on the world, but of course on the factory of the world, that is China, but also all of Asia. So that's a big systemic risk for the world economy and for the Chinese economy first and foremost. That, I think, is the external shock that Premier Li yesterday referred to in his speech, calling for creating buffers and being prepared for this external shock with fiscal policy and monetary policy. What else can it be?
What positions should European companies have when it comes to China as it relates to the U.S. sort of targeting China? Obviously, there's been tariffs on EVs coming into China, but not as bad as some member nations had called for. Germany actually was sort of against it, and I know that the Mercedes chairman was here. He is against that. He's all for free markets. What kind of opening do you think the Trump administration strategy on tariffs gives to European companies to do business in China?
For sure, the policy evolution in the U.S. has been a wake-up call for Europe. We see it in multiple fields, not only economic field, and it probably gets Europe closer to China. I don't think that the EU tariff on EV is more than a rebalancing act. It's driven by subsidies. It's a very rational approach. It's not meant to suppress Chinese competition, and actually it's not suppressing any of that competition. It's adapting to that level of tariffs, and negotiations are going on. It's a very different approach because the EU is an institution. It's not a nation, and it has no suppression objective like probably some of the US policy has. So that's probably quite good for Europe to tie a closer relationship with Chinese companies in China.
But more targeted tariffs are coming, reciprocal tariffs. That's going to add to the uncertainty.
Yeah, sure, that's going to add to the uncertainty. But again, I think the Chinese economy and multinationals operating in China are well prepared for the tariffs.
All right. Denis, Depoux, thank you so much. All right, still continuing coverage from the Diaoyutai State Guest House, Villa 14 here at the China Development Forum. Back to you guys.
Right, Steve, fantastic conversation there. More coming up, of course, with Steve throughout the course of today and this week. Right, if you are one of our Bloomberg clients, you can check out that interview that Steve just did and plenty more, of course, that we've done just about across many of the different conferences taking place already as we get warmed up here for Monday. Check it out, TV Go on your Bloomberg terminal. To quick glance at markets, and we are extending losses here in Hong Kong for a third day. More on the market roundup just ahead. This is Bloomberg. Welcome back. So just an update here of one market that should be up and running at this point in time. We should be about 20 minutes into the session, but no trading just yet in the Philippines. So nothing, no details have been provided here by the exchange. It is a delayed market open this Monday, and of course we'll keep you guys on top of things once we have more information coming through there. out of the PSE in Manila. For now, I guess, well, sit tight. There's nothing else to do. All right, Sinopec is one stock we're tracking here in the open, and of course we mentioned, of course, an extremely busy earnings week for Chinese markets and across the region as well. And Sinopec was actually out with some numbers here. A slump in full-year profit out on Friday. Markets reacting to this going into right now. We're down about 4% on that. Telco stocks also in focus here as well. A report of a U.S. investigation here. The FT is reporting this one, Rebecca. I believe we were talking about this earlier.
Yeah, essentially U.S. investigating these concerns that some of these Chinese telecoms are ignoring the restrictions on how they operate in the U.S.
Yeah, we'll get you more on this in a moment. A lack of reaction, or a little bit there, if you could. Right, the story across the benchmark, CSI 300 holding steady. The benchmarks here in Hong Kong extending losses to a third day. Volumes are lighter on the lighter side of things. There's plenty more ahead. This is the China Show.
Good morning and welcome back to the China Show. Here's a quick peek at the HSI about half an hour into the session. We are down about 0.4% there. We started the day looking a little bit positive, but actually, of course, turned a little bit negative. And part of the story is the absence of sort of concrete details when it comes to optimism over the Chinese economy. In particular, we have had somewhat sort of mixed signals, but it's a big week for earnings as well. Hopefully, perhaps there may be some kind of catalyst that comes through. We've got some of China's biggest consumer names, some of China's biggest banks also coming through. But what we have tended to also see is this sort of pricing in, particularly when it comes to those Chinese names, a pricing in of excellent or robust earnings, and then seeing some kind of weakness once those numbers are confirmed.
Yeah, and I think we saw that with Tencent last week, which I think one of our guests pointing out, they couldn't see anything wrong with the earnings, but then shares, of course, fell 3 to 4%. We're seeing that with Meituan coming up on your screens very, very shortly. And I think with this stock in particular, it's actually struggled. It's been trading in a very tight range for the last, I would say 5 or 6 weeks or so. In fact, at 159.30. And by the way, I should mention, this has really been one of the best performing stocks, right? So right before the initial rally took place in September, we were trading at about $100. The fact that we're trading at 160 right now and well off highs does tell you how far the stock has actually come up. We're actually right now just bobbing just on around a 50-day moving average on Meituan. Speaking of, it's thrown its AI hat in the AI ring. Tencent has also come out with an upgrade as far as its own model is concerned. BYD is coming out with earnings today. You have Ant, and there's a headline coming through as well, which I believe we'll get to. In fact, why don't we talk about that now?
Yeah, that's right. Well, Ant joining the AI race, as we've seen with really so many companies over the last 3 or 4 weeks, post DeepSeek boost, with a cheaper model built on Chinese chips.
Yeah, there we go. The race to the bottom on the cost to operate a lot of these AI. We'll get more details on this in a moment here. But yes, so we talked about Ant. Tencent, I just mentioned that, came out on the weekend with an upgrade, and Meituan said it will be developing its own in-house AI model. Right, now going into the week, keep an eye on Turkey. Today, late on Sunday, regulators came out and said no short selling. They've also relaxed some of the measures and rules around buybacks, and unsurprising, given that the stock market last week had its worst week in about 17 years. And this is a weekly look, of course, at the performance of that benchmark, down 17%. We're getting some weakness coming through in the currency in the early goings of Monday. The rest of the region, though, let's have a look at that, 0.4 to 1%. A lot of this is a drag coming through out of these big names in Hong Kong, 0.4 to 1%. And yeah, so we're fairly mixed across the region here, but I guess on a good note is U.S. futures. Flip the page, you see U.S. futures on your screens. Coming up shortly is a more comprehensive list of those contracts. And maybe we could put this down to tariff relief or exhaustion. Mark Cranfield joins us right now for more context on what's going on. Mark, you don't normally see these kinds of moves, at least for this time of the day, for these contracts. What's going on here?
Yeah, I think it is, as you say, relief is a huge part of that. I mean, U.S. equities have not had the best start to the year, really, since President Trump's inauguration. They've been underperforming other parts of the world. So equity investors will be very happy if we get next week, if the tariffs which come in are not as dangerous as the ones that have been proposed in the past, if they're not as widespread, if they're more targeted and specific areas, and it's generally dialing back the rhetoric on the trade war fight, then obviously equity investors will be very happy to endorse that, particularly given the fact that shares have not been doing so well. But as we know, there's more than a week to go. Things can change quite quickly. And so far, nothing suggests that we're not going to get tariffs and some reciprocal tariffs from other countries as well. So traders will still need to live with a world where there are various trade issues in place. There is a trade war going on, and it's going to probably last for quite a long time, even if it's not as extreme as the one that they first thought. If you put all those things together, it really, once again, it questions the whole idea of US exceptionalism. So we might get a bit of a knee-jerk rebound in US equities this week. It probably isn't going to last very long because the world is getting used to the idea that all of these policies being put in place by the United States are detrimental to the US dollar. They're a long-term headwind to US equities, and it will shift more money to other parts of the world. Now, that is particularly relevant when you've got somewhere like China and Europe who are beginning to look a lot more interesting for global investors. Last year, that wasn't the case. The United States was the only story. There was no alternative. You had to be in US equities. That is not the case anymore. There are other places looking as attractive, maybe even better. The story of rebuilding going on in Europe could be a long-term theme. There could be a lot more money shifting there as well. So now there is genuine competition for US equities, other parts of the world. So really, the whole idea that there will be any kind of tariffs is really not a great one for US equity investors.
Mark, I mean, just help us connect the dots of that tariff story to what we're seeing in the Chinese yuan. Yeah. And again, although perhaps a recalibration of the impact of those reciprocal tariffs on April 2nd, we still also have now word potentially of these levies on Chinese-made vessels as well.
It looks as though the central bank in China, the PBOC, is doing a very deliberate job of trying to make sure that the market is on the defensive when it comes to the Chinese currency. So again today, they lifted the dollar-yuan parity. It's the highest today since President Trump's inauguration. There was no particular reason for them to lift it again. It's a clear message to the market. What the PBOC doesn't want is for traders to be too bullish on the yuan before all these tariffs start to fall into place. And as you say, there's a story about potential levies on Chinese ships as well. So China is taking the approach that the outlook is still very murky. It's still very difficult for Chinese companies. And the last thing they want is for the market to be very bullish on the yuan and then have to reverse very quickly, which would be much more damaging because then you would get a huge reaction in the market where dollar-yuan spikes very quickly. The authorities would have trouble containing it, and it would be very messy for financial markets. Much better to keep the yuan slightly on the weak side. It will gradually grind higher. Then, if there are severe tariffs put in place, the reaction will be relatively small in the market. On the flip side, if it's a very positive outcome, if the whole tariff thing is much less than expected, the yuan could actually strengthen. That is much easier for the PBOC to manage than a yuan that is rapidly deteriorating.
Mark, thank you. Mark Cranfield there with today's context across these market moves right now. It's a big week ahead, earnings, macro, and everything in between. Geopolitics, why not? Let's talk about that. So earlier on, we did hear from the Chinese Premier Li Qiang, who says that Beijing is prepared for shocks that exceed expectations from President Trump's reciprocal tariffs that are forthcoming. Let's bring in Stephen Engel, our man on the ground in Beijing for us at the China Development Forum taking place there. Yeah, Steve, get us up to speed. What's taking place so far from yesterday going into the current state of affairs at the moment?
Well, obviously, everyone is talking about those unforeseen external shocks that could potentially be greater than expected. That's what Li Qiang talked about. In fact, his speech here in Villa 14 at the Diaoyutai State Guest House in western Beijing really focused on three main areas. One, that those external shocks potentially, as we move into the next phase of Trump tariffs, could be greater than expected. But also, it's about the efforts that China is making to improve its domestic consumption and domestic economy in the face of these external shocks. And that obviously includes opening up the market further to foreign direct investment, which, by the way, last year, because of the slowing economy here in China, dropped by the most since 1990. So that's why foreign executives are here trying to read the tea leaves, get a sense of how much China is going to further open and be open to FDI. Obviously, Tim Cook from Apple is here. Steve Schwartzman of Blackstone is here. Andrew Forrest of Fortescue Metals is here. Mr. Burla from Pfizer. There's a whole suite of C-suite executives here trying to read what Li Qiang and the messaging is from China. But the third main point is about efficiency in industrial China. And AI was again brought up. And this is something John Quelch, a professor at the Duke Kunlun University here in China, a long-time economist looking at the Chinese economy, thinks is perhaps an unintended consequence out of the White House trade policies on China improving its efficiencies. Let's hear from John.
Every time tariffs are put on for Chinese manufacturers, Chinese companies double down on extra efficiency in order to eat part of the extra cost of the tariffs. So in a way, ironically, the tariffs are actually an extra motivation to China to become even more efficient and productive.
Obviously, this has been a well-telegraphed trade policy from the Trump administration. China has this time to prepare its contingencies.
Steve, I mean, talking about sort of reading the tea leaves there, one conversation that has been absent so far this year, of course, is these high-level official meetings between President Trump's team and President Xi Jinping's team. In the absence of that, we do have a U.S. Senator, Steve Daines, perhaps taking on this role of a go-between. You spoke to him earlier.
Yeah, that's right. So the Republican senator from Montana was sent here essentially as the unofficial envoy of Donald Trump. He was here at the China Development Forum yesterday. I chatted with him briefly, but he didn't give me an interview then because he was on his way to the Great Hall of the People, along with 7 other American CEOs and chairmen of big corporations, meeting with Li Qiang at the GHOP, Great Hall of the People. And after that, he headed to the airport to fly back to the United States, but gave me and my Bloomberg News colleague, Lucille Liu, an exclusive interview over the phone. This was the key takeaway.
It was a constructive conversation. I think the President Trump position was heard loud and clear, and the Chinese received that. They understood it, and we're hopeful that we'll see decisive actions taken to stop the flow of these precursors.
Mm-hmm. Were there signals that they would proceed with some further actions on fentanyl?
Yeah, I think we had a constructive wrap-up in the meeting. And again, I'll allow my Chinese counterparts to provide their readout on the meeting. But it was, I think we ended on a constructive note.
Okay, and how would you say is the biggest barrier right now to Trump and Xi meeting? Is it fentanyl, or are there other barriers at the moment?
No, I don't think so. I think it's just a matter of finding a time that's going to work for both President Xi and President Trump.
And do you think that will be in the U.S. or China or a third country?
It's a good question. I don't know. Again, they're two busy leaders dealing with a lot of issues. The China-U.S. relationship is one of the very important issues, and I'm confident they're going to find the right time and the right place to meet.
One of the things, Senator, that I've been hearing a lot through state media and from Chinese officials is they don't necessarily know exactly what the Trump administration wants to address these 20% tariffs. What would it take from the Trump administration to potentially reduce those 20% tariffs and mitigate any other tariffs that might come down after April 2nd? And is this something that the Chinese leadership addressed with you?
Well, again, the president made it very clear. He made it clear to me. He's made it clear to the American people. he's made it clear to the Chinese government that stopping the flow of these fentanyl precursors is his highest priority. And it'll be difficult to have any conversation about tariffs and non-tariff barriers until the fentanyl precursor issue is resolved.
And there was the key line from Senator Denis, essentially saying, until China, to the satisfaction of the Trump administration, addresses the fentanyl precursor issue, there cannot be other discussions on other potential tariffs coming down the pike and other trade policies. Fentanyl, the top priority of the Trump administration, and that has left the Chinese leadership wondering exactly what they need to do, short of obviously putting a full-page article in the front page of the People's Daily admitting that they are basically party to this policy or non-policy, this unofficial and illegal, export of precursors to China, to the United States. So obviously that's not something that China is going to do publicly. So it leaves a lot of uncertainty on the U.S.-China relationship until we do get a Xi-Trump summit, which nobody knows when that possibly could happen. Steve Denis told us possibly by the end of the year. That's a long runway, a long time period to resolve such sticky issues that is disrupting global trade.
Yeah, fascinating peek behind the curtain there between some of those key sticking points for China and US, particularly, as you say, in the absence of any finalized certain meeting between President Xi and President Trump. That's Bloomberg's chief North Asia correspondent, Stephen Engel, in Beijing there for us. And still ahead on the China show, we are talking Asia market sentiment with CSOP Asset Management CEO Ding Chen as the company lists leveraged and inverse single stock ETFs in Hong Kong.
Yep, and it started out as a quiet, it's still quiet, but certainly a day to come to the market is a lot better these last few minutes or so with the news coming through out of Ant and her scoop here that Ant managed to touting this breakthrough in AI using Chinese chips. Alibaba's up, and as you can see, that's lifted the Hang Seng Index off the bottom. Plenty more ahead. This is Bloomberg. Welcome back. You're watching the China Show. It's a big Monday. So starting, well, right now, investors can bet on, take some leverage up, get into NVIDIA, 2x. You can do the opposite, in fact, inverse ETFs also on single stock names. In fact, that is thanks to CSOP Asset Management. They've launched here in Hong Kong Asia's first batch of leveraged and inverse ETFs tracking, as you can see on your screens, some of these single stocks that are traded overseas. Total 9 products focused on, as you can see, the names on your screens. In fact, let's get more on the product launch, what the market thinks of this, how much demand, how much flows we're expecting, and the current outlook for these markets and sentiment. Joining us exclusively is Ding Chen, the CEO of CSOP Asset Management. Ding Chen, good morning, and thank you for taking the time to speak with us. I know it's a busy day for you. I saw you on stage. You banged that gong to start off, of course, the trading of these new products. I am curious, and I was wondering if we could start, how did you guys come up with these specific names?
Thank you. Good morning, and it's really a pleasure to be here. And today we have a big celebration to celebrate the 9 single stock LI ETF listed on Hong Kong Stock Exchange. You can see we have more than 200 people attend this event. And you're asking about why we pick up those. Actually, it's 5 names to list it as our Asia first batch of single stock LI. Actually, there's 3 different categories. First one is tech names. We pick up NVIDIA and Tesla. The reason is because the single stock LI ETF was introduced first by European country and then at 2022 introduced by U.S. market. And the U.S. market, we see growing demands and popularities on those. And in U.S., the most tradable leverage single stock leverage ETF is NVIDIA and Tesla. So the first time in Asia, we also bring NVIDIA and Tesla to list it 2 times, inverse 2 times. Also, another sector is crypto. So everybody is, loves to talk about cryptos, and U.S. is trying to get certain crypto names into their reserve. And so that's why we pick up MicroStrategy and Coinbase from that part. And also MicroStrategy and Coinbase is also the third and fourth most tradable single stock ETF in US as well. And surprisingly, in Asia time, we bring Berkshire 2 times on Hong Kong Stock Exchange. The reason behind that is because, Warren Buffett obviously is people in this area, people think he is the investment god. So a lot of investors are Warren Buffett's followers. They're seeking for value-focused investment ideas. But unfortunately, Berkshire A shares is far, far more expensive, like $780,000 US a share. But here in Hong Kong, you can, using only 780 Hong Kong dollars and participate to this 2-time Berkshire leverage products.
Chen, I'm curious, when we think about those 3 different buckets that you just laid out there, what is your expectation in terms of demand? And are you seeing a different type of investor profile for those 3 different types of stocks?
Yeah. For this, I think for these 3 categories, they will attract different kind of investors. But in general, single stock LNI market, we see, the demand is very high. For instance, like in 2024, in the U.S. market, in general other leveraging inverse products, we see outflows. But for the single stock leveraging inverse products, we see, tremendous cash inflow of more than 12 billion US dollars into this sector. And among these, 12 billion, based on our estimation, about 30 to 50% are coming from this region. So we think, definitely because they trade on Hong Kong Stock Exchange. And for those investors used to trade NVIDIA or Tesla or MicroStrategy and Coinbase on US time zone, right now they don't need to do the night shift. They can trade on their daytime. And also, the demand is also coming from, we think, for those tech names and also the big names, their shares performance is highly driven by after trading hour news. And after trading hour news, and I think that part is like, the Hong Kong market will give the investors a lot of advantage because we are trading at after trading hour. So we were saying it will be interesting. We're thinking it's not only, at first stage, probably, the beginning, probably we will attract more Asian investors first. And I think, give it time, probably the U.S. investors, they can trade Hong Kong, stock market as well.
Chen, do you have any initial projection of how much assets you think these new products will attract? And that's another way of asking you, when does liquidity really become a non-issue? Because, first day of trading, we're not really seeing a lot of liquidity just yet.
Yeah, you're right. So I think the liquidity is building up, gradually. Like 2017, when we introduced the first batch of LNI leveraging inverse index-based ETF come to the market, the liquidity and the market sentiment is gradually, pick up. And for us, obviously, we are the leading LNI leveraging inverse product issuers in Hong Kong. Right now, our firm's leveraging inverse ETF AUM from 0 to right now is above 35 billion and 3.5 billion. Let me see. So 3.5 billion US dollar. At the trading volume, right now, among the top 10 most traded ETF, we will see like 4 to 5 are coming from leveraging inverse product. So I think, we need to give them a little bit time to see more inflows on screen trading volume pick up.
Okay, thank you so much for joining us this morning, Ding Chen, CEO of CSOP Asset Management, and thinking about some of those single stocks there mentioned. Meanwhile, Elon Musk is trying to reassure Tesla employees after the firm's shares dropped almost 50% in just 3 months. At an all-hands meeting, he encouraged his staff to hang on to their stock, saying Tesla will soon be capable of driving autonomously with a software update. That's something he's been promising since at least 2016. Tesla is facing a backlash over Musk's role in President Trump's administration. Protesters have targeted the company's showrooms, vehicles and charging stations, both in the US and across Europe.
Yeah, and I think he mentioned Cathie Wood's name, if I'm not mistaken, there to his employees as someone, of course, who sees the underlying story. And the reason I bring that up is because we're speaking with Cathie Wood, of course, and we'll see what she makes of that, how she's traded this, and also what her calls are, for example, in BYD, which reports earnings later on today. So it's a big week coming up, suffice to say. Right, Boeing suppliers on your screens right now. So a couple of things. Well, these are traded, of course, over in South Korea. Huni Technologies, and the story here is you have this fighter jet contract win coming out of the company. It's worth noting, of course, there's a representation out of Boeing's executives in Beijing, of course, in this ongoing conference there. Right. All right, it's another good pivot to this next stock. If you haven't had your breakfast just yet, turn away now. Okay, so this is a company, Zensha Holdings, listed in Japan. It's a company that operates Sukiya, that's the restaurant chain. Yeah, there was a rodent that was found specifically in miso soup. I'm not sure what miso soup is a relevant detail here, but yes, it was found in one of the broths here at the company, prompting this plunge in the shares you see on your screen. So yeah, that's our way of sneaking that in between your meals, breakfast and lunch, and hopefully that whatever is that mental image you have goes away. And why not? Bright spot here. U.S. futures on your screens. We're up 0.7% on NASDAQ futures going into, of course, the Monday session. And this is really on the back of, I guess, I wouldn't say renewed optimism, but maybe some of the tail risk being pushed aside as these new tariffs are seen as being more targeted coming through there out of Donald Trump. Okay, plenty more ahead. On top of that, it's a big week as far as eco goes. You have some inflation prints coming through out of the U.S., of course. You have U.S. consumer confidence numbers coming through towards the end of this week. So you put those two things together, the PCE and the U.S. consumer picture, then you get really a sense of how this is really impacting U.S. consumers and the conversations there. Right, apart from that, we're also looking at a big earnings week, 2.2 trillion in MSCI China market cap reporting this week. And I think we have a graphic that actually shows you this. Everything from BYD, and I think Sunny Optical also reports later today. And I think, interestingly enough, we're looking for the next catalyst here.
That's right, for Chinese markets. I just want to jump into your point there about this being a big week, particularly for some of those central banks. We do have some breaking news lines now. The BOJ's Ueda saying that they may adjust the degree of easing if the outlook is realized. So we'll get more details on that as they come through.
Yeah, a lot of ifs there. Okay, more breaking news coming through. So Morgan Stanley has just come out and they've raised their forecast for Chinese growth this year by 50 basis points, 4.5%. It's worth pointing out that despite that revision higher, that's still actually, if I remember correctly, that's still on the lower end of the range we've seen so far. But in any case, of course, the latest on Wall Street here to come out with a revision here in terms of Chinese growth.
That's right, the lower end of the range, but it's abutting against really this risk-off sentiment that we're seeing among investors in China about just wanting to see more concrete evidence and more signs of a stabilized Chinese economy. We really sort of have somewhat failed to translate that momentum from AI, all of the optimism around DeepSeek, into sort of broader shift in sentiment when it comes to the economy really finding a bottom, particularly when we think about that property sector.
Yeah, absolutely. And I think some of the commentary coming through, and Stephen Engel, of course, is in Beijing for us. He's covering, of course, the big conference taking place there. And really one of the commentary which has come through there is that the market has already reacted to the green shoots that have come in place so far as it pertains to this market, right? So what started out as a very quiet session has now turned positive. HS Tech, and I think the big news earlier on top of Morgan Stanley, I'm just going to bring this up on my screens, is Ant Financial coming through as well with a breakthrough in AI using Chinese chips, and that was really the catalyst, which is why you're seeing green on your screens right now, in the order of about 0.5%. Now, of course, we're coming off the biggest two-day slump on Hong Kong equity markets if you go back, I think, back to October. So I think some context there. Right. Now, we are entering, it's Monday, isn't it?
It's a Monday. It feels like we've almost already had a weekend. I mean, we got a very full docket, not just for today, actually through the whole week.
It kind of makes me think about, and here's the busy calendar of events this week. So everything from, you have your big financial and economic discussions, then we go into the weekend where the joke last week was fund managers becoming fund managers, right? So we have the Hong Kong Sevens coming through as well.
Yeah.
We have our own Bloomberg Family Office Summit taking place. You have Hong Kong Sevens, you have Art Basel, and everything in between. What's the difference between a summit, a conference, symposium, and conclave? Anyway, that's
feels like the beginning of a joke we're not allowed to tell on this show.
No, and which is why we are moving things along. And let's have a discussion right now on family offices. And we're here, joined, in fact, on the set, Mahesh, Harilela, Family Council convener for the Harilela Group and partner at Chartwell Family Partners. Good morning.
Good morning. Thank you very much. Thank you very much.
How's business? What have you been busy with? Yeah, where do we start?
Where do you want to start? But let me just share with you. I think what's important is our family's been in Hong Kong since 1929. We're a 100-year-old family, and Hong Kong is our home. It's a place where we started to develop our business opportunities, and it's a place where my family has instituted as nowhere else in the world, our home. So in that, our family has grown to 165 family members, spanning 4 generations. And the key element of what we're trying to determine at the moment is, how do we go forward? What's the process involved? Is there an internal beacon that we need to be able to follow? Or do we chase advisors or follow advisors in the way that we need to try to understand the facets of activities that are important and relevant? But the key element, I think, for all of us is really understanding, what does our family legacy stand for and what does it mean? And Hong Kong is our home. So if we look at Hong Kong as our flag, our bearing that we can always associate with, I think it's the most important point that will give us the baseline, the root, to be able to redevelop and envisage what Hong Kong potentially can become. So that's my introduction.
I mean, thinking about that point, about what Hong Kong can become, there has been this discussion for a long time now, it feels like more than just a few years, about Hong Kong's focus as a hub for family offices.
Yes.
And I guess the big question is, has it done enough?
Well, what is enough? There has to be a starting point, right? The key element is that the government put up a beacon after what Singapore established. What is a family office, and where do we want to go in the vision of a family office? So drawing money into Hong Kong is important, but how do we create the structure? How do we create the professional attributes that family offices, single family offices, as well as multi-family offices can attach to? So we've studied, we look at CUHK, they have the Families, Center for Families Business, where they've come up with a white paper in saying, what are the key elements that single family offices need? What are the key elements in trying to drive the families to come to Hong Kong? I think that's also an anchor point. And where they looked at this is that in the white paper is to establish a professional field, a professional institutionalized element that supports the family offices. Right. And in that study, as we invite people in, and I think it was Deloitte that came up with a report of 2,700 family offices established in Hong Kong, that consists mostly of local as well as foreign. But what we need to do is to invite professionals to come back. And professionals are the very element that will help Hong Kong actually grow. Right. Right?
Is that, just to paraphrase, is what we're lacking software or hardware? Is it a talent pool issue? Is it something the government can control, or have we just not waited enough for some, not all of the measures that have been put in place in the last, I would say, 2 years, to just simmer and bear fruit?
Well, I think there are two parts to this, right? Hardware is existing. The hardware meaning the buildings, the infrastructure, the availability, and how things function in Hong Kong. Our government functions, our city functions, infrastructure is in place that allows people to have mobility. The thing that's missing is really the software. And that's really the mental capacity, the professionalism, as well as the engagement and encouragement for foreigners to come in. Now, when I say foreigners, I also include China. But we also understand that the West has different ways of looking at things. And I read a fantastic book by a person called David Epstein that wrote a book called Range, is that diversity is the key to being able to grow and sustain your growth. And it's not about just saying, okay, we pull in the talent for the short term. We have to think short, middle, long term. And that process, we need the professionals to come in from overseas with different spectacles, different views.
So what is the biggest obstacle there, and whose job is it to fix that?
I think everyone has to participate. So here it is. Companies in Hong Kong said, okay, look, we need to look inward into China, our motherland. We have to help and provide the growth attributes to China. Now China has grown, and in the little hiccup in the economy, China will come back strong. But China is looking outwards as well, and we've lost the outward focus. And when we look outwards, has China been able to look through the Western vision or ASEAN vision to see what's happening in the rest of the world? So if we have infrastructure like we have Cyberport and we have the Science Tech Park and we incubate tech, are we looking to bring in the ASEAN players? Are we looking in to bring in the Western players to come in to look for funding? Are we providing the professional services? And then are we allowing them to enter into China and vice versa? China needs to go out as well as other countries can come in. So recently, I think it was yesterday that China announced that they're inviting international companies to come into China. Come in, open up an office, set up. We've given you visas, we've given you visa-free access, come in and set up. So what's that saying to Hong Kong? We've had it. We've had visa-free access for decades. Come in, come through Hong Kong, look at Hong Kong, park your wealth in Hong Kong, go into China, take a look, and then when you're ready to establish in China, make your placement. Go in full-footed. Right?
I mean, that brings up a lot of key issues. One, or topics, let's put it that way. One is, what sets Hong Kong apart from other financial centers in China for the future, like Shanghai, for example. The other conversation that's taken place over the last few years is that while it's obviously good to focus on mainland China for Hong Kong, it is, of course, what sets us unique, the proximity to mainland. Is there something different about Hong Kong? Is Hong Kong simply China's financial center, or is it an international finance center? So the reason I bring those two things up is, what do you think officials here should do to attract more non-mainland Chinese business into the city?
There's the premise of how Hong Kong established itself under British rule was that it was started off as a backpack economy. People came in from the UK in backpacks and started to engage in the work environment. That helped us and flourish in our restaurants and our food and beverage availability. And it started through that became the investment culture, came the business side of it. So if we invite people in from international markets to come in, let's start with the ease of visa process. Come in, take a work for 3 months or 6 months, get your feet wet, understand what Hong Kong, the availability that Hong Kong presents, get your feet wet and start working in the environment. And then once you have found your footing, establish a visa process that's much easier to process. Get that involved, and that's government side of it. But the corporate side of it is that we have to change the focus of saying we only hire you if you speak Mandarin or Cantonese, and English is a byproduct. But the global environment for business and technology and other developments, medical as well, is English as the primary language that's spoken universally. So how do we encourage English to come back into the fray and then allow that opportunity to invite foreigners to come back in? So then we look at our education process and we look at our grassroots of Hong Kong that go through public systems. We need to be able to encourage English as teaching medium to be able to assimilate, allow, as the West comes in or China opens up, to allow Hong Kong to be able to flourish as well.
Mahesh, in 10 seconds or less, the next big metric we should be looking for that would show us that that's successfully happening?
Well, you talked about symposiums, symposiums, conferences, and all of that.
Conclaves, summits.
I just recently held a workshop for the discovery of a new space economy. And that new space economy is something that we need to focus on. Hong Kong needs to create the regulation. We have a meeting coming forward, but that's one aspect that adds to growth in GDP, 3 to 5%.
Okay, excellent. Thank you so much. That's Mahesh Harilela, convener of Family Council for Harilela Group and partner of Chartwell Family Partners as well. And you can get an insider's guide to the money people shaking up the finance hub here in Hong Kong. That's our Hong Kong edition newsletter, which is out every Thursday. You can sign up via Bloomberg.com/newsletters. Stay with us. You're watching The China Show. This is Bloomberg.
It's not exactly unbridled optimism you're seeing, but we'll take these gains in any shape and form they come. And some good news coming through here in the form of this scoop on Ant Group, this AI breakthrough using specifically Chinese-made semiconductors. In fact, for more on that specific story, let's bring in Min Lo, of course, who has the details of this.
Yeah, so this is potentially a game changer because Ant is claiming that it's able to train AI models using Chinese chips from the likes of Alibaba and Huawei at a 20% cheaper cost. And it's training models that uses the MOE machine learning model. This is mixture of experts machine learning model. Essentially, it breaks down a task into small data sets to make it more efficient. You can imagine it's similar to employing a team of experts, each focusing on a specific part of the problem to enhance the overall efficiency. So typically such an approach will require the very high bandwidth memory chips like NVIDIA's chips, which are under export control. But Ant is saying they are able to achieve the same results as if you were using an H800 chips, which is the scaled-back version of the NVIDIA chips that were tailored especially for the Chinese market in order to meet the export restrictions. And it's also claiming that they were able to beat Meta on some of these benchmarks, such as English language understanding, but it claims that there are still some teething problems with training because, especially when it comes to stability, if you just change the hardware or the AI structure, model structure, just a little bit, it leads to a jump in error rate. But still, it's an important breakthrough because it would really lower and slash that development cost because the MOE model has been pretty prohibitive because it relies on those chips that are not really accessible to smaller firms, and it could put China on track to being self-sufficient in the tech race if they're able to make more efficient computational models that do not rely on these very advanced chips.
Okay, so a game-changing moment. Does it fundamentally then shift the rules of the game and the calculus for policymakers when it comes to US-China tech competition?
Yeah, so the way this competition has evolved was because of the policies from the US. And the two sides, US and China, are competing on very, very different paradigms because recently we had Jensen Huang saying that the DeepSeek moment, the fears around that and whether that would affect his company is unfounded because he says companies will still need better chips with greater computational capacity, and he's still doubling down on his strategy of having bigger GPUs with more transistors, more memory, more processing cores. But China is going the opposite way where they're going for cheaper chips, but they're changing and making the computational model more efficient. So it's a very different way of doing things here.
Okay, well, keep our eyes peeled. Thank you so much. That's Bloomberg's China correspondent Min Lo for us. And now, Swedish retailer IKEA says it's looking for new ways to manage costs and be more resilient amid the global trade war. Inter IKEA Group CEO John Abrahamson Ring spoke to us at the China Development Forum in Beijing.
We believe in a global, regional and local supply chain, and that we have been done for many decades. We have worked with that. We are 87 years old as a total IKEA, so we have a very long-term perspective. We are not a public company or anything like that, so we don't have to worry about the next quarter or the next year. We think decades at IKEA, so we are continuing to build the right structure based on what we do. With that said, we do believe that open rule-based trade is something very positive for the world, and it's been very sort of positive also for IKEA, of course. So,
what are the main discussion points, though, in the boardroom when you talk about building in supply chain resiliency? We had supply chain challenges, obviously, through the pandemic. Now it's because of a trade war.
Yeah, but as you said, we're constantly looking at how to become even more resilient, and I think this regional approach is actually benefiting us. So to supply 75% of what we sell in Europe, and to supply 80% in Asia, for Asia is very good, and now we're building up also capabilities in Americas, and that we have been doing for the last decade. We have opened more markets in Americas. We've opened Colombia, we've opened Chile, we've opened Mexico. We continue to evolve our business in Canada and the US, and of course we will continue to become even stronger also as a region in Americas.
Yeah, so how do you keep the costs down when there's so much uncertainty on raw materials and sourcing of the products?
Yeah, we continue to. The main driver of cost, or an opportunity for reducing cost, is to grow in volumes where you can scale on fixed costs, and that is a real key enabler of that, of course. Then, of course, in all the transformations we are doing now with environmental and sustainability intentions, also has to come with even lower costs. If sustainability becomes more expensive, it will have very little effect for the world and also benefits for IKEA. So we are looking into even smarter ways of utilizing raw material, finding ways of circular flows that when you scale that can become very...
that means recycled material.
Right? Exactly, recycling. But that has to also happen on scale. So for recycling, it's a lot about identifying, being able to trace material so that you can use that in a way, and then you have to find a scalable model of how to do it, and that is a lot of progression in many industries, etc., but also in home furnishing.
Yep, and that was the IKEA Group CEO, John Abrahamson, bring with our colleague, Stephen Engel, of course, there in Beijing. Plenty more ahead here on The China Show.
Good morning and welcome back. Now, South Korea's Constitutional Court has dismissed the impeachment case against Prime Minister Han Duck-soo. Han was accused of aiding and abetting President Yoon Suk-yeol's abortive declaration on martial law. Bloomberg East Asia government editor John Herskovitz joins us now for more. John, firstly, what does this decision mean in terms of the leadership in South Korea?
What we're going to see now is that Han Duck-soo is reinstated as prime minister, and he's reinstated as the acting president of South Korea. The decision mostly concerned Han's actions as the acting president. The court avoided anything to do with the martial law declaration, which is something that the opposition camp contended. So what we have now is still the undecided leadership in South Korea, because we're waiting for the decision from the Constitutional Court on the impeachment motion against President Yoon. The decision may come in a few days from the court. We don't have a time frame for it, but if the court decides that the impeachment passed by Parliament is justified, Yoon is removed from office. It sets the clock ticking, 60 days to a presidential election, and in that time, Han will continue to serve as acting president, barring any unforeseen circumstances.
Right, and John, I'm just reading some of the latest lines coming through here out of Han himself, calling for this bipartisan cooperation in terms of state affairs. And I'm wondering if you could give us some context here. So while this domestic political drama is taking place, there is, of course, the backdrop of, and just to mention, South Korea is an extremely exposed economy as it pertains to these tariff conversations. And I'm wondering what investors can latch onto as far as the leadership is concerned to be able to shelter the economy from these trade headwinds.
Yeah, one thing with Han is that he served in both in conservative and also progressive administrations. He's a diplomat. He's seen as a centrist, kind of a steady hand through the process. So I think the call for the bipartisanship is to make sure that there is some sort of sense of leadership as South Korea is going to face the tariffs that Trump is going to announce on April 2nd globally reciprocal tariffs. South Korea's economy is incredibly exposed. It's an export-driven economy. So having some sort of stability there is warranted. But again, there's so much up in the air for this. We just don't know how the decision will go with President Yoon. And also the main opposition leader has an appeal for one of his for a conviction on graft that's coming up this week, which can also fold into the mix. There's just a lot of turbulence going on in South Korea now. And Han said that he respected the decision. He also said he wants to get down to urgent work. So I think he's trying to show that through this period, he will be able to serve as acting president, and hopefully he'll try to draw upon some of the bipartisanship that has been a part of his career in South Korea.
Bloomberg East Asia government editor with the very, very latest. John Herkovitz there, following all of that drama in South Korea and elsewhere in the world. Here are some of the big global stories that we are following this morning. Turkey has formally arrested Istanbul's mayor Ekrem İmamoğlu on corruption charges. The move to jail İmamoğlu could prevent President Erdogan's main political rival from running against him in the next elections. The arrest has already triggered mass protests in several cities. Turkey's capital market regulator has banned short selling and relaxed share buyback rules to cushion potential market turmoil. Canadian Prime Minister Mark Carney has called for an election for April 28th after requesting the dissolution of Parliament. Polls indicate the race will be a close contest between Carney's Liberal Party and the Conservatives, led by Pierre Poilievre. Both parties have promised tax cuts and are making the case for who would be better at negotiating with President Trump over tariffs.
Right, just a brief look at markets right now. So earnings is a big theme we will continue to check, revisit, review, and then look ahead to, of course, through the course of this week, 2.2 trillion in market cap on MSCI China only, and then let alone, of course, you have other markets too. Our reporting this week, today is the big one, of course, out of BYD, and some of the names on your screens as well. Hang Seng Index about 90 minutes into the session, and we'll take advantage of this visual on your screens and just pick up from the lows, and then just return back to the lows of Morgan Stanley. And note this hour, revising higher their GDP forecast for China for the year to now 4.5%. That's it from us here today. We'll see you all tomorrow.